Now we're on. Sorry about that, guys. Couldn't hear me before, right? Now you can hear me. Now I see the volume working. Yes, live back down here on the floor. Happy to be here and happy Wednesday. It is a busy one at that. Volatility is back here, guys. A lot of animal spirits in the marketplace right now. We're going to go into a little bit on some of these crypto stocks, Bitcoin related stocks, and what is going on in there. And then we're going to hit right into the topic of the day, which is IV crush. Yes, it is very active down here, Rodney. Not as much right now as it was this morning. I was down here this morning. I had an interview on Schwab Network around 9:15 or so. It was really busy, and I'll be back down here at 2 o'clock. I have a an interview on Fox Business, but it is pretty busy all day here. Okay, let's head over here real quick. What I want to show you really quick, guys, before we get into IV crush. Let me show you guys a hint. Let me show you guys a shortcut on something here. Okay. Can everybody see this Mara, M-A-R-A, call spread that is up on the screen right now? This is the position we have. Okay. That's the position we have. Long the 21, short the 25. Okay. Great position. Put it on way cheaper. We put it on, I don't know, $4 ago or so. Stock is up 3 and change today. Why is it only trading though a $1.55 or so? Okay, our long call is $2+ in the money. Our short call is $2 out of the money. Why is this only trading around $1.50, $1.55 or so? The answer is skew. Does everybody understand what that means? Does everybody understand what skew means? And I don't want to spend too much time on it. We can do that tomorrow or Friday because I got to get into the IV crush stuff. But does everybody understand what skew means? And an easy way, a real easy way to understand and know where the skew is. Okay, look at the individual deltas of both of these options. Okay, our in the money call, roughly a 70 delta. Okay, that's fine. You know, it's a couple bucks in the money, right? So if you had to guesstimate what the delta of that option would be, you'd probably say, somewhere 60, 70, 80, somewhere in that range. That's good. But our short option, which is $2 out of the money, look at the delta. Okay, if we're looking at an option that is out of the money, normally we would say, boy, that's got to be less than 50 delta, right? Especially an option that here is 10% out of the money, $2 out of the money. But yet, look at the delta. That option is trading like it's actually slightly in the money. That's why the delta there is greater than 50. The reason it's trading with that high of delta, okay, higher than it normally would be, is because if we take a look at the implied volatility on these options here, okay, our long call is right here, and the short call, the skew is to the upside. You can see it is much higher implied volatility. That higher implied volatility adds delta to that option. Okay, so the skew in Mara, the skew in MSTR, the skew in IBIT, the skew in all of these crypto related stocks, the skew is to the upside calls because the big demand is to the upside calls. Okay, and it's presenting itself very similarly to what we saw a few years ago with the meme stocks, AMC, GME, where we saw those gamma squeezes. We'll talk more about this tomorrow or Friday. Okay, but I just wanted to point that out. here is the topic of the day. Okay, can everybody see this on the screen? And if you want, we will actually post up. I'm going to do that right now, and I'll do it again later on. Going to post up a link to what we are discussing today. You're all going to want to have that. Okay, how do we trade the post earnings crush? Okay, I had to add this in here, right? How many? I haven't had one of these in probably 30 years, maybe even longer than that. But didn't we all grow up drinking Orange Crush and Grape Knee High and had to put the crush on there? Okay, so a couple things before we actually go into some examples here. Number one, how do we know it's going to happen, right? We always get told it's going to happen, that after earnings come out or after an event comes out that there's going to be a crush, but how do we know it's going to happen? Okay, when will it happen? How much will these options get affected by? Okay, and then we need to compare and look at the Vega versus the IV implied volatility. Okay, so number one, how do we know what will happen? What doesn't the market like? Okay, or I should say, what makes volatility go up in the marketplace? Okay, just like what's happening today, right? VIX is up. VIX is up 176 right now, or over 10%. It was up about 14% earlier. Bingo, Derek, good answer. Market doesn't like uncertainty. Uncertainty, volatility goes up. The analogy I always use with that, guys, is think about what happens. You're driving down the road, okay, and all of a sudden you see the police lights swirling behind you, okay? How does that make you feel? To me, if that happens, okay, amongst other times that could happen, you get all tensed up, right? You kind of get that sick feeling in your stomach, right? Well, it's the same thing. It's that uncertainty about, oh man, what's going to happen to me? But once that uncertainty is gone, we normalize. Our bodies normalize. The market normalizes. Volatility normalizes, regardless of what the outcome is when we're talking about earnings. A stock moving higher, lower, unchanged, whatever it is, okay, things are going to normalize. When does it happen? Immediately. Immediately. Okay, earnings come out after the close of the market. We open up the next morning. Boom. You are going to see that crush. Or earnings come out that morning, like this morning with Target, and we're going to look at that here real quickly here. And that volatility adjusts immediately because the news is now behind us. Now, how much will IV drop? That's going to be something important we're going to get to after we look at some charts here, because that is really critical to understand. If you guys are ever going to trade something around earnings, you have to understand IV crush. We do it. We talk about it all the time in our rooms. But if you're ever going to put it on a position by yourself, you must understand that concept. Okay. Now, I'm going to use my cursor here. I know there's a lot of option strikes up on the board here right now. Okay. This was target yesterday at the close of the market. Okay. Pre-earnings. Okay. So the stock closed yesterday right around 156. Okay. If we look at the monies, okay, we can see an incredibly, ridiculous implied volatility level of 130, 135, whatever it might be. Does everybody see that? This is yesterday, pre-earnings. Okay, the monies, we're trading roughly 130 implied volatility. And you know what? That's going to be a great topic for another day, is what actually is implied volatility and what does it actually mean? We'll do that another day. Okay. Now, when I had, as you can see here, put in some volatility overrides on those two strikes, that's because those strikes, the 140 and the 170, okay, those were the expected move away from where the stock closed yesterday. So the expected move in target was about 16 bucks or so yesterday. Okay, so I was keying in on the 140 to the downside and the 170 on the upside. And you can see, this was at the close of the market yesterday. You can see what I put in here, where I thought that volatility was going to go down to today. Okay, does everybody see that? That was the vol crush I was pricing in to the market. Now, be aware, this is what I labeled as week one, meaning the current expiration. Okay, you can see this is November 22nd. This is this week's expiration. Now, let's go to the next slide. Okay, the next slide is showing week two, next week's expiration. Okay, so same thing. If we look at the same exact strikes here that I was highlighting. So, you know, the expected move out of the money both to the downside and to the upside, the puts and the calls. You can see that the implied vol before my adjustment was way lower than this week's. It was like 130 implied vol for this week. It's, you know, it was 68 for next week on the put side. Pretty similar on the call side. Okay, so the added implied volatility is always going to be in the options closest to when the news event is coming out. For earnings, this week's options. Okay, this week's options. Okay, now you can also see the override that I put in there for those options for week two. A crush down to, is at 34 and 29. Okay, why am I doing that? And how do I know what those vols are actually going to go down to? Well, I know it because I've been doing this for 35 years. Okay, you won't really find this information on the internet. You'll see a lot about vol crush. You know, there's tons of videos, tons of stuff out there about vol crush. But really how much that vol crush is, this is based on my experience of doing this for 35 years. So let's take a look at the next slide here. This next slide here shows 1 year implied volatility in target options. So how do we know that vol crush is going to happen? Because we see it here. Okay, we can assume this was earnings and this was earnings and this was earnings, and we know that this was yesterday, this was earnings, and then immediate. Okay, so with 100% certainty, that volatility is going to get crushed. It will normalize. That's one of the consistencies and one of the characteristics of Vega, of implied volatility, is that it will always normalize. When it's really, really cheap, it is going to move higher. And when it's really expensive, it is going to move lower. Now, we don't know the exact timing, but with 100% certainty, it will happen. Okay? Does everybody understand this implied volatility chart in target? This is a 1 year chart. Okay, and we take it back 5 years, 10 years, 20 years. We're going to see the same thing. You see the exact same thing. Okay. Now, here's where vol is today. Okay, here's where vol is today. I took this snapshot about an hour ago or so to prepare for today. Now, we do have to look at different strikes because the stock got crushed so badly, way beyond the expected move. So we still have to compare like options, meaning at the money options, to where they were yesterday. Okay? The news is out. The stock absolutely got annihilated. Vol has normalized. What do I have on the screen right here? Okay, that was the option I was looking at yesterday, the 140 to the downside, and that was based on at the money being 156. Remember what that 155 or 157 and a half at the money vol was yesterday. Well, what is the at the money strike now? Stock is down at 123, 124 area. Look where that implied vol is. 60%. Do you remember what I had programmed in as what I thought that vol was going to drop down to post earnings? I'll go back a slide or two and you'll be able to do it later as well. 60%. 60%. Okay. That's what I had factored in. And that is where we are trading at right now. Okay. Now, is it always going to be exact to the T? No, it is not. Do we need, though, to be in the ballpark? Yes, we do. Now, let's look at week 2. Okay. As a reminder, here was week 2, meaning the November 29th options. Okay. The at the monies yesterday, right around 70-ish. Okay. So I modeled down to 35-ish or so. And here is where we are as of an hour ago. $36. We had modeled it at 35. Does everybody see that? Again, we're not going to be exact. However, we can always be pretty darn close. And it's consistent. And again, it does not matter what the move is, even if it is a surprise move, bigger than expected move, smaller than expected move, it does not matter. Once that news is out, that crush is going to happen. Does everybody see that? And speaking of crush, yeah, you guys could probably figure out what the word was today. Made it a layup, made it an easy one for you. Crush is our word of the day today. Make sure you get in there. I know yesterday I think was close to a record on the wheel. I'd love to break that today. Derek, Bobby, Herbert, you guys are on the hop. You guys are first one in today. Okay, Robert, Barry, Black Lion, Steve, all you guys are coming in now. Great. Okay. Did you guys kind of follow along what I did looking at yesterday's implied vol versus where it is today and why it happened? It is imperative to know that it is going to happen, because if you don't understand and if you don't know that that is going to happen, when you put your potential trade into your platform and you get your P&L, you get your risk graph, if you don't have those volatilities adjusted in there, you might as well be closing your eyes and throwing a dart at the wall. Those numbers aren't going to mean anything to you about what that potential P&L is. Okay, now, this is one, and we'll review this tomorrow. Intuit has earnings after the close today. Okay? So I'm doing this because this is not an I told you so yet. Okay? You guys are all going to have the opportunity to compare this to where things go tomorrow. This is the current at, or where we're looking on the strikes that we have. Okay? We have the 710 strikes. As of today, this week's 710 is trading about a 72% implied vol. I am modeling this at 40. Our long option, next week's option, is currently trading around 49% implied vol. I'm modeling it at 26. We will compare live tomorrow where those vols go. Okay, here is a 1-year chart in Intuit, implied volatility. You can see the same pattern, maybe not quite as severe as what we just saw in Target. Okay, but you can see that same exact pattern. This is probably earnings here and earnings here and earnings here, and now we're getting higher up. Okay, tomorrow morning, regardless what Intuit does, up, down, unchanged, that thing is going to be down here. We will see where it actually goes to tomorrow morning. Okay, now, I'm not going to go through the Palo Alto one because I have this up here as well. Similar situation to Intuit. I've showed you guys where the current implied vol is, where I am projecting it to be. Okay, this is the pre-earnings estimate. I put a link up to this, what do you call it? Not spreadsheet. Mike, this presentation? Sorry, thanks. Brain fart there, guys. I put a link up here to this presentation, so you'll be able to download it and refer to it. Okay, so we'll go through that tomorrow post earnings, but I put a Palo Alto one in here also. This one is actually as severe, as steep as Target was. Okay, this is how we know it will happen. Now, how much? Right?
Jimmy, you ready?
Right? You might be saying, all right, Scott, great. I know what's going to happen. How much is it going to happen? And this is the info. I'm going to adjust my camera there. There we go. This is the info you're not going to find on the internet anywhere. This is the info that you get here. This is your guideline. This is your guideline. Okay? Week one. When I say week one, again, that means the current week. So if earnings are today, okay, this Friday's expiration. If earnings are tomorrow, this Friday's expiration. That is week one. You can typically factor in those options will decline by typically 50% or even more. Okay, but I am always going to use just 50, maybe even a little less in my modeling, because that's going to help my modeling. Okay, the next week, week 2. Okay, in our case, week 2 is November 29th. It's going to be a little less of a crush. Okay, typically 40 to 50%. I will usually model it closer to 50%, because what I want to do in my models is I kind of want to underestimate a little bit how much the short option is going to get crushed and overestimate how much the long option is going to get crushed. And then if the P&L analysis still looks good because I've got a little bit of a fudge factor in there, great. So that's what I do. Now, if we go out beyond week 2, you will see less and less of a crush happening. Does anybody know why that is? Does anybody know why that is? And I'm going to pull up a live chart. I know, Rad, are you in here? Rad, you had specifically wanted to look at Snowflake, which I want to do. But I'm only going to do that if you're in here. So you better be in here. I'm putting you on the spot here. But does anybody know why the further you go out in time, oh, beautiful, rad, love it. The further you go out in time, we don't see as much of a vol crush. Why is that? Okay, John says theta decay. Well, let's take a look. And let's take a look live with Snowflake. Okay, and what I'm going to do right now, guys, is I am just going to put up an implied vol chart. Okay, and this is a 1-year chart. Okay, just like we saw in the presentation with Palo Alto and Intuit and Target. Okay, what I have on the screen right here is a 30-day, whoa, that's too big. Hang on. I have a 30-day implied vol chart. The reason I use 30-day is because, think about it. The predominant number of our positions are what? They're pretty short term. They're within 30 days. So I want to get, historically, the most accurate implied vol based on the way we trade. Okay, now, here's the reason why we don't see as big of a vol crush the further we go out. What if I was trading 180-day options, 6-month options? If those were our positions, what would we see? Well, I'll show you what we'd see. What do you see on the graph now? What do you see on the graph? Again, this is implied volatility. That red is 30-day. Whoop, hang on. And this orange right here is 180-day. Smoother, right? We don't see the fluctuations like we see in the short run. Just think of it. If you're gathering data for anything, you're collecting data for a project or whatever it might be, the more data you have, the more time that you've collected your data from, you're not going to have as many outliers, right? The smoother that data is. Same thing with implied volatility. So we don't see the big fluctuations over time, which is why we don't see the big vol crush, because vol, it does go up in the earnings, but it doesn't go up as much as the short term. And then I can also put on here 360-day. Let me take the 180 off. There's 360, so 1 year, and you can see pretty steady, pretty steady. So now, Rad, you wanted to look at what exactly in Snowflake. You want to be bullish, bearish, neutral, because we're going to go through this. And I know we're going to go on, probably for another 5 minutes or so, guys. Good thing I don't pay by the minute down here on the floor. So, Rad, what do you want to look at? Bullish, bearish, neutral for Snowflake. And we're going to go through how to look at and adjust that volatility. Okay, bullish. Okay, and I think you had wanted to do like a calendar or a diagonal, right? So let's look at a bullish calendar spread. Okay, first thing we have to look at, guys, Snowflake has earnings after the close today. Okay, the stock right now is 129? Okay, so the stock is 129. What is the market pricing in for an expected move in Snowflake today? Okay, and this is for this week. So what's the market pricing in? Okay, we look at the at-the-money straddle, right? Yes, you can look on Thinkorswim, maybe some of the other platforms, and it's going to tell you what that expected move is. But, we got to learn things the old-fashioned way. So how much is the market pricing in here, guys? If we look at the 129 at the money straddle, it's right about 16 bucks. Would you guys agree with me on that? Give or take. It's loud down here. Okay, there we go. Don, thank you. We can use 15. I used 16. So if we are bullish and we want to take advantage of IV crush, okay, we could look at 129 where the stock is right now, plus 16. We could target the 145 strike. Okay, so that's what we're going to do here. Now, based on what we just went through and based on this slide right here, everybody, I'm going to look to adjust our vols for this week by about 50%. And next week, a little bit less than that. So I am going to put in here this week's 145 down at, let's say, 100 implied vol because it's at about 197 right now. And then next week's 145, it's at 103 right now. Okay, I'm going to put it at a 55. Does that seem fair? Based on, kind of what we said there? Does that seem fair? Okay, so if we do that, that calendar call spread is going to cost us probably right around 60 cents. Okay, the market on that spread right now is 44 bid, 66 offer. Let's say we pay 60 cents for that. Maybe we get it for 57 or 58 cents, somewhere in there. But let's say this thing, 60 cents. How do we know if that's good, bad, or indifferent, right? You could just say, oh, wow, 60 cents, that's cheap. I'm going to do this. But how do we know if it's good, bad, or indifferent? Well, here's why. Here's why. And here's what you need to do, guys, whether you use Thinkorswim, Tasty Trade, Interactive Brokers, whatever it is. You've got to model it with the adjusted volatilities. Here's why. Here's why.
Appreciate it. Yeah.
Here is a chart. Let me put this out to Friday. Okay. You put on this bullish calendar call spread, and let's say we get to 145. That's your target. Okay. This thing shows it makes about $1.50. Okay. That's what this is down here. So if we paid 60 cents, what this is saying is at 145, it's going to be worth about $2.10 on Friday. Okay, now let's compare that to not adjusting our volatilities at all. So if you put that calendar call spread on and you said, wow, let's see what that 60 cents gives me. Okay, now look at the difference. Now you're talking, whoops, come on. I don't want to try you for free. I don't even know how I get that off here. How do I get that off? I don't know. I don't want to get that. There we go. Okay. Now this is showing you with like a $3 profit if you go to 145 rather than the real potential profit because we know those vols are going to be adjusted. So the real potential profit of $1.50. Okay. That's still really good reward to risk, but you might look at that, put this into your platform and say, oh man, 60 cents and this thing could be, I can make $3 on that. boy, I'm going to do as many as I can of that. But that is not real. That is not real. Does everybody understand that? Does everybody understand that? Mike, are we closed on the wheel? Okay. Does everybody understand that? I don't expect you to completely follow, okay? Completely follow everything in one half an hour setting. This is very complex. There's a lot of nuance to it, but it is something that is critical to understand if you are going to trade around earnings. So I highly, highly encourage you to copy that link that we put up here. Okay, complicated, but yes is right. I highly encourage you to copy that link that we put up here and review it on your own at one point. Okay? All right, guys. I hope this was helpful for everybody. It is, oh, this definitely looks like a record today. This definitely looks like a record today. All right, let's give it a whirl here, guys. Let's give it a whirl. There we go. Round and round it goes. Today's winner, Derek or Herbert? Derek or Herbert? Herbert, are you here? Herbert, are you in the house? You've got to be here to win. You've got to be here to win. Come on, Herbert. Let us know if you are here. Congrats to you. Herbert is in the house. Okay. Nicely done. Herbert, please send me an email to prosperswag@prospertrading.com. Send me an email there soon with your mailing address, size swag. Okay. Derek fighting Illini. Let's go. Yes. Let's go, Illini. I am an Illini alum. Let's go. Although I will say, after putting my fourth kid through Indiana right now, he's a sophomore there. Big game against Ohio State this weekend. So, all right, everybody. Thank you, thank you, thank you, thank you, thank you. Again, this is so important, guys. Make sure you copy that link so you have this presentation. And also, I will be on live at 2 o'clock this afternoon, 2 o'clock Central Time, right here next to me from the floor up here in front of the camera on Fox Business. Okay? Tune in. 2 o'clock Central Time, Fox Business. I'll be talking with Liz Clayman. Don't know what we're talking about yet, but I will be here. And yes, smash that like button. Thanks, actually, crush that like button today. All right, everybody. Thank you so much. Have an amazing day. We'll see you later.